Hello. If you look around the financial world right now, you will see that the markets have become really nervous about the high levels of inflation that exist globally. The last time investors faced a situation like this was 42 years ago. The reason why this is causing uncertainty is because no economist has experienced it professionally for themselves. They may have experienced it, but they were children then. So in this investor roundup we look at this uncertainty. It is legitimate to ask what is causing the uncertainty. On the one hand, the still high inflationary environment that I mentioned yet. In such an environment, bonds do not perform well at all, and in the case of equities and equity-based investments, you need to choose with due care to succeed because of the sector shift. Another reason is the Fed's interest rate hikes. Although this has been expected before, the extent of this is unknown. You could say now that you don't invest in US Treasuries already on the market, and let the Fed sort out the rest in-house. This is no coincidence that this is creating uncertainty among investors. So there are two things I would like to draw your attention to. One is that the Fed is raising interest rates to curb US inflation, which will in turn have an impact on the exchange rate of the dollar. As a lot of developing countries are indebted in dollars, there will be an indirect impact on the economies of other countries. On the one hand, this will have a knock-on effect on them through trade, but more importantly for you, if you want to invest in developing countries, it is very difficult to calculate the impact. The other is that the effect of the interest rate rise is that companies are able to raise finance more expensively. And you saw part of the effect of that in the fall in the Nasdaq earlier this year. Simply by not raising interest rates in other areas, the performance of companies in those other areas, but otherwise in the same sector, is outperforming the US. And you, as an investor, are obviously going to put your money where you will achieve more result. You just need to know how much more. Now let's look at the Russian-Ukrainian conflict. We are not going to go into the historical or political background to it, and I think you have already seen summaries of this which present these issues in an excellent professional way. From an economic point of view, this war is fortunately a localized event, and we hope that it will remain so until it is brought to a quick conclusion. So when you look at the impact on markets, you have to look at geographical distance. This is good news from an investor's point of view. After all, you have a choice. A Japanese trader will be less affected than a Hungarian. Another piece of good news is that geopolitical events in themselves rarely cause a recession. Unless the problem spreads to a global level, order is restored relatively quickly. Of course, this is conditional on the economy having sufficient momentum. Let's start the financial aspects starting with a brief overview. The performance of different economies is measured by the developments of GDP. This is expressed in US dollars for comparability. Of course, you can say that Russia is big enough to have a sufficiently large internal consumption in rubles. But if you think about it, what matters to you now is how it has performed internationally compared to other countries. In this picture you see the evolution of Russian GDP over the last 20 years. You can also observe the downturn caused by the credit crisis of 2008 and the subsequent growth. The fall in 2014 reflects the annexation of Crimea, after which there was growth until the appearance of COVID. Not bad so far, but just to give you a basis for comparison, let's add another country. Let's take Italy as an example, which is far smaller than Russia. Yes, you are right, the Italian economy is outperforming compared to Russia. That is why it is vital for Russia to end the war as soon as possible because of the funding. Let us look at today's events in this light. Russia is currently a major player in global trade in raw materials, of which it accounts for a significant share of total supply. It is no coincidence that the price of crude oil has skyrocketed with the partial cutoff of Russian gas. OPEC has increased production, but with further sanctions on the horizon, the question is whether it can produce enough and fast enough to balance it. The other option, which you may have heard in the news, is for the EU to buy LNG from America. But there is a problem with that. America is no longer subsidizing the oil wells because of the switch to renewables. Companies with economically viable drillers are meeting local demand, while shale oil and shale gas production, which is too expensive, has stopped. Yes, you guessed it, if the union buys LNG, the companies that have plenty of spare capacity because of the high price will step in. So an already high-cost extracted shale gas comes at an even higher price due to transportation. Fortunately, there are not many examples of this, and they are more experimental. After all, you need a suitable port for this, and a receiving market that can pay for it without overloading. Changes in the price of oil also depend on the outcome of the war. If the European Union fully accepts that it will not buy any Russian oil and gas at all, then it will obviously have to be replaced from elsewhere, and the price of oil and, with it, the price of fuel will remain permanently high. However, with the war winding down quickly, there is the prospect of a significant reduction. Let us look at the impact of sanctions on the Russian economy and what they can do. Among the best-known sanctions is the disconnection of several Russian banks from the SWIFT system, making it virtually impossible to move money in and out of Russia. This also makes it difficult to pay for raw materials, impossible to invest, and causes a whole series of other difficulties. The picture shows the Russian stock index denominated in rubles. You can see that this has hit the Russian economy very badly, so it is legitimate to ask how much we should fear that they will turn to China and that what the European Union does not buy will be sold in the Far East. This could happen. After all, China is not its own enemy. It is very likely that Russia needs money, and since there is no market here for the raw materials, cheap raw materials are more of an opportunity for China. But it should be remembered that, although both are huge in territorial terms, they are still not in the same league. For this, one only has to look at the GDP of the two countries. But why it matters? You can see that Russia's economic performance dwarfs China's. That is why China needs global connections far more than cheap raw materials. That's why you hear reports that major Chinese companies with an international presence are either unwilling or reluctant to buy from sanctioned Russian firms. That leaves only the smaller capitalization firms in the game. Now let's look at how the war has affected finance outside Russia. Either trading with Russia has been suspended, or you have seen significant exchange rate losses. Since the world's fleeing currency is the dollar and the fleeing investment is the US Treasury bond, if it is needed to find a safe place for money quickly, many people will choose one of these two. And that leads to a temporary rise in the exchange rate. Here, for example, you see a strengthening of the dollar against the euro, meaning the process has already started. But once the conflict has subsided, we can expect the euro to strengthen again. This is obviously not only true for the euro, but is true for all investments that have to do with the geographical area. To better understand this, let's take a look at the Hungarian context. The Hungarian forint appreciated spectacularly in January on the back of the interest rate hikes, but what it gained then and there it has since lost because of its geographical proximity. You can see this in the dollar exchange rate, and you can see it when you look at the forint-euro exchange rate. According to the Hungarian National Bank, there is no fundamental background to the current situation. So once the conflict is resolved, order is expected to be restored. Obviously, in the meantime they will monitor events and take action if warranted. What does this mean for you? As I mentioned at the beginning of the video, the bond market is performing poorly at the moment, so the price is falling. Expressed in forint, but investing in foreign currency, the most common place to find bonds is in mutual funds. Back then, if you bought a bond fund worth €100 at an exchange rate of 360 forints per euro, you would have paid exactly 36,000 forints. Now that the bond exchange rate has fallen, you might find that the same amount of bond funds is now changing hands for just €97. At an exchange rate of 381 forints per euro, that's worth 36,957 forints to you. In other words, for these investment funds, the increase in the exchange rate is due to the weakening of the forint. This exchange rate is good for you when selling, but less advantageous when buying. Let's also look at Hungarian equities. If you look at the index of the Hungarian stock market, the BUX, you can see that it has fallen significantly since the conflict broke out, and with it the ETFs that track the BUX have fallen. Here the market has priced in that some companies have Ukrainian subsidiaries or have been actively trading with Russia and Ukraine. Then the reason for the fall is the fear that these subsidiaries will cease to exist or that a halt in trade will cause a serious loss of revenue. But often the main reason for this fall is geographical proximity. Thus, even those companies with no or relatively little exposure to Russia and Ukraine are easily underpriced. These companies offer a good buying opportunity after due review, as they are underpriced by the market without any fundamental reason. Having reviewed the current situation, let's look at what can be expected in the investment area. As I mentioned, the markets are nervous, which is why the previous momentum has been broken and volatility has emerged. This would be present this year even without the war conflict. But a recession should not be expected unless the Russian-Ukrainian conflict spreads to the global level. It is expected that central banks will reduce the money supply in response to the inflationary environment, either by halting bond buying programs or by raising interest rates. This year is definitely needed to resolve this, so it will not be resolved tomorrow. Let's take a look at what you can see for yourself right now in investing. In a high inflation environment, the real returns available are falling. When the Fed raises interest rates in response, financing becomes more expensive, making it harder for companies to perform well. The sector rebalancing in equities has been going on since the beginning of the year and is expected to continue. Indeed, there are sectors of the equity market that traditionally perform well in a rising interest rate environment, and others that underperform. If I want to summarize in very broad terms, I would say that value stocks are doing well, growth stocks are underperforming. However, 2022 requires activity in terms of investing, as you can observe significant variation within the same sector. So what you can do yourself is to choose actively managed solutions. You can do this either with an actively managed investment fund or with a private banker. After all, the passive strategy of the ETF will track the fall. Obviously, an actively managed fund can also fall, just less than an ETF, which copies mandatory. Choosing these is not an easy task, so we can help if you ask. You can contact us using the link in the description. The next thing you can do is to stay calm. Panic is the worst advisor. In looking at any bumpy section, experts have found that those who stayed calm and didn't give in to panic had much better results. Last but not least, diversify. Here you can even choose from an even wider range than before. After all, you don't know what events are coming and which asset classes will be affected.